that I know that multi-consulting book is still needing a lot of practice, but this is the time that we actually dive into one of the another book that I've was very interested in reading to you and myself. It's basically a book by Paul Pignatro. It's about financial modeling and valuation, and this book is literally uh, a more numerical book. But let's just start with what this book says, and it's actually let me just see the table of contents for how long this book is. Just a second. This book is approximately about the given pages 386. It's approximately about the previous books that we've read, but I guess most, if you are at this level, you must be having a lot of knowledge about finance, because this book is literally just a snapshot of whatever you read in your 12th class. So I'm really sorry I would not be able to kind of preface this or give you a snapshot of this book, because I'm not having it kind of that technical setup available with me. It's I tried my best. I've been trying since the last stream, but it's just didn't happen possibly. So part one is just about the financial statements and projections. So that's the chapter number one. That's the first section, and the first chapter that we're dealing with is the income statement here. So the income statement measures a company's profit or loss over a specific period of time. A business is generally required to report and record the sales it generates for tax purposes, and of course tax on sales made can be reduced by the expenses incurred by generating those sales. Although there are specific rules that govern when and how those expense reductions can be utilized, there is still a general concept that profit is equal to revenue minus expenses, which we all literally know, right? So net income is equal to profit minus tax. It is basically whatever the income that you arrive at. We all know that you're going to arrive at the final income when you actually deduct tax from your profit, because you do, because tax is, even if it's not your expense, it's the expense you have to incur, all right, if you're making profits, right? So that's there. And now, however, income statements have grown to be quite complex. The multifaceted categories of expenses can vary from company to company, and analysts will need to identify major categories within the income statement in order to facilitate proper analysis. For this reason, one should always categorize income statement into 9 major threads that are given: revenue, cost of goods sold, operating expenses, other income, depreciation and amortization, interest, taxes, non-recurring and extraordinary items, distributions. No matter how convoluted an income statement is, a good analyst would categorize each reported income statement line item into one of these 9 categories. This will allow an analyst to easily understand the major categories that drive profitability in an income statement, and can further allow him or her to compare the profitability between several different companies. And analysis is very important in determining relative valuation. This book assumes you have to have some basic understanding of accounting. So we'll just briefly recap the line items. Revenue. Revenue is the sales or gross income a company has made during a specific operating period. It is important to note that how revenue is recognized vary from company to company, or may be different from the actual cash received. So revenue is recognized when realized and earned, which is typically when the products have been transferred to once the service has been rendered. Cost of goods sold. Cost of goods sold is the direct cost attributable to the production of the goods sold by a company. These are the costs most directly associated with the revenue. This is typically the cost of the materials used in creating the product sold. Gross profit, which we all know, gross profit is one of the 9 categories listed. It is a totaling item. Gross profit is the revenue less the cost of goods sold, and is helpful in determining the net value of the revenue after the cost of goods sold is removed. One common metric analyzed is gross profit margin, which is gross profit divided by the revenue, which will calculate the totals, or which will calculate these totals and metrics for Walmart later in the chapter. A business that sells car, for example, may have manufacturing cost. Let's say we sell a car for $20,000, and we manufacture the car in house. We have to purchase $5,000 raw materials to manufacture the car. If we sell one car, $20,000 in our revenue and $5,000 in the cost of goods sold, that leaves us with $50,000 in gross profit, 75% gross profit margin. Now let's say first quarter operations we sell 25 cars. Then that's 25 into $20,000 or $500,000 in revenue. Our cost of goods sold is 25 into $5,000, $125, which leaves us $375 in gross profit. Right now, these are the operating expenses, which are basically incurred as a result of performing its normal business operations. These are the relatively indirect expenses related to generating the company's revenue and supporting its operations. Operating expenses can be broken into several other major subcategories, the most common of which are selling, general and administrative expenses. These are all selling expenses and all general and administrative expenses of a company. Examples are employee salaries and rents. Advertising and marketing. These are expenses relating to any advertising or marketing initiatives the company employs. Examples are print advertising and Google AdWords. R&D. These are expenses related to furthering the development of the company's products or services, because every company wants to develop their product further. So they are always constantly researching and they are just literally constantly spending money, or figuring out what kind of changes that can be done in the product and what more can be achieved from the development of this product, right? Then there were, let's say, in a car business, we have employees to whom we have paid $75,000 in total in the first quarter. We also have rents to pay $2,500, and we ran an advertising initiative that cost us $7,500. Finally, let's assume we have employed some R&D efforts to continue to improve the design of a car that cost roughly $5,000 per quarter. Using the previous example, our simple income statement looks like this. So revenue, COGS, gross profit, percentage gross profit margin, operating expenses, SG&A, advertising, R&D, total operating expenses, other income. Companies can generate income that is not core to their business, as this income is taxable. It is recorded on the income statement. However, since it is not core to business operations, it is not considered revenue. Let's take the example of the car company. A car company's core business is producing and selling cars. However, many car companies also generate income in another way, financing. If a car company offers its customers the ability to finance the payments on a car, those payments come with interest. The car company receives that interest. The interest is taxable and is considered additional income. However, as that income is not core to the business, it is not considered revenue, it is considered other income. Another common example of other income is income from non-controlling interest, also known as income from unconsolidated affiliates. This is income received when a company has a non-controlling interest investment in another company. So when a company A, invests in another company B, and receives a minority stake in company B distributes a portion of its net income to company A. Company A records those distribution received as other income. EBITDA, earnings before interest, tax, depreciation, and amortization, is a very important measure among Wall Street analysts. We will later see its many uses as a fundamental metric in valuation and analysis. It can be calculated as revenue minus costs minus operating expenses plus other income. It is debatable whether other income should be included in EBITDA or not. There are two sides to the argument. It should be included in EBITDA. If a company produces other income, it should be represented as part of EBITDA, and other income should be listed above our EBITDA total. The argument here is that other income, although not core to revenue, is still in fact operating and should be represented as part of the company's operations. There are many ways of looking at this. Taking the car example, we can maybe assume that the financing activities, although not core to the revenue, are essential enough to the overall profitability to be considered as part of EBITDA. It should not be included in EBITDA. If a company produces other income, it should not be represented as part of EBITDA, and other income should be listed below EBITDA total. The argument here is, although it is part of the company's profitability, it's not core enough to the operations of the business for which the company has been incorporated. So determining whether to include other income as EBITDA or is not so simple and clear cut. It is important to consider if the other income is consistent and reoccurring. If it is not the case, more likely to be made that it should not be included in EBITDA. It is also important to consider the purpose of a particular analysis. For example, if you are looking to acquire the entire business and that business will still be producing uh, that other income even after the acquisition, then maybe it should be represented as part of it, or maybe that other income will no longer exist after the acquisition. If it case, it should not be included in EBITDA. Another example, we're trying to compare EBITDA with the EBITDA of other company. That it is important to consider if the other companies also produce that same other income. If not, then maybe it is better to keep the other income out of the EBITDA analysis to make sure there is a constant comparison among all the company EBITDA. Different banks and firms may have different views on whether other income should or should not be included in EBITDA. Even different industry groups within the same firm have been found to have different views and defensible views on this topic. As a good analyst, it is important to come up with one consistent defensible view and stick to it. Let's assume in a car example, the other income will be part of EBITDA. Revenue, costs, gross profit, percentage, gross profit. Why they are constantly repeating this? I'm going to tell you that this chapter is going to be hella boring because we have so many times been through all of these terms since our 12th class. But I think it's really giving me a a kind of a first-hand different definitions. It's wow. Depreciation and amortization. Depreciation is the accounting for the aging and depletion of fixed assets over a period of time. Amortization is the accounting for the cost basis reduction of intangible assets, intellectual property such as patents, copyrights, and trademarks, for example, or their useful life. It is important to note that not all intangible assets are subject to amortization. We will discuss this further. EBIT, subject to similar to EBITDA, earnings before interest and taxes, is also utilized in valuation. EBIT is EBITDA minus depreciation minus amortization. So let's assume the example of a car company has $8,000 in depreciation and amortization each quarter. So notice we have also calculated EBIT margin, which is defined as EBIT divided by revenue. Interest. Interest is composed of interest expense and interest income. Interest expense is the cost incurred on debt the company has borrowed. Interest income is commonly the income received from cash held in savings accounts, certificates of deposits, and other investments. Let's assume the car company had 1 million in loans and incurs 10% of interest per year on those loans. So the car company has $100,000 in interest expense per year, or $25,000 per quarter. We can also assume that the company has $50,000 of cash and generated 1% of interest income in cash per year, $500 or $125 per quarter. Often the interest expense is netted against the interest income as net interest expense. EBT. Earnings before taxes can be defined as EBIT minus net interest. EBIT, EBIT margin, interest expense, interest income, net interest expense, EBT, EBT margin. Okay. Taxes. Taxes are the financial charges imposed by the government. Obviously, they have to be they have to be paid. They are imposed on earnings before taxes. Non-recurring and extraordinary items. They are events or expenses that are occurring one time or not pertaining to everyday core operations. Gains or losses and sales of assets from business closures are examples of non-recurring events. Such non-recurring or extraordinary events can be scattered about in generally accepted accounting principles, income statement, and so it is a job of a good analyst to identify these items and move them to the bottom of the income statement in order to have EBITDA, EBIT, and net income line items that represent everyday continuous operations. We call this clean EBIT, EBITDA, EBIT, and net income. However, we do not want to eliminate those non-recurring or extraordinary items completely, so we move them to this section. From here on out, we will refer to both non-recurring and extraordinary items as simply non-recurring items for simplicity. Distributions are broadly classified, defined to payments or defined as payments to equity holders. These payments can be in the form of dividends or non-controlling interest payments to name the major two. Non-controlling interest is a portion of the company or the company subsidiary that is owned by another outside person or entity. If another entity A owns a non-controlling interest in the company entity B, it must distribute a portion of entities B earnings to entity A. That's the kind of distribution incomes that they're talking about. Net income, because we have recommended moving some non-recurring line items into a separate section, the net income listed prior is effectively an adjusted net income, which is most useful for analysis, valuation, and comparison. However, it is important still to represent a complete net income which all adjustments included to match the original given net income. So it is recommended to have a second net income line defined as net income minus non-recurring events minus distributions as a sanity check. Shares. A company's shares outstanding reported on the income statement can be reported as basic or diluted. The basic share count is the count of the number of shares outstanding in the market. The diluted share count is the number of shares outstanding in the market plus any shares that would be considered outstanding today if all the option and warrant holders that are in the money decide to exercise on the securities. The diluted share count is best thought of as a what if scenario if all the option and warrant holders who could exercise would how many shares would be outstanding now. EPS, earnings per share, is defined as the net income divided by the number of shares outstanding. A company typically reports a basic EPS and a diluted EPS divided by basic shares or diluted shares respectively. It is important to note that each company may have a different definition on what exactly to include net income when calculating EPS. In other words, is net income before or after non-controlling interest used, or after or before or after dividends. For investors, it is common to use net income before dividends have been paid, but after non-controlling interest, investors have been paid. However, we recommend backing into historically the company's EPS to identify the exact formula they're using. We will illustrate this formula for the Walmart case study as follows. Basic EPS is net income upon basic shares, and diluted EPS is net income upon diluted shares. So in this stream, it was a really short stream of around 20 minutes, but we discussed about the basic financial terms. I guess you must have recalled all of these 9 terms that we generally use in the income statement. So I guess that's how we have to continue. We have to refresh our memory. So I think the most fascinating part of this stream was studying about the other incomes, whether they're included in EBITDA or not. That was new to me because I might have lost touch with this concept, but it's really nice, and will be keep keep up with these kind of streams continuously. So I'll meet you in my next stream. Goodbye and take care.